Hey guys, welcome back to the channel. One of the most frequent questions that I receive on my channel is, Jake, which investment bank is best for me? Charles Schwab, Fidelity, or Vanguard? The upfront answer is you can't go wrong with any one of these three banks. All three of them, in my opinion, are excellent. I recommend all three. But in this video, we're going to cover the differences between these three so that you can choose which investment bank is best for you. And I gotta give a quick disclaimer that the policies of these banks do change over time. Stuff that I am saying in this video is accurate as of today. However, if you're watching this video years in the future, potentially some of the policies of these banks might have changed over time. So we're gonna start by comparing all three of these banks and talk about what do these three investment banks do correctly. The first one is they all allow for zero commission trades. So if you want to buy and sell individual stocks or ETFs on their platform, you can do that entirely for free. If you're still paying to make trades, you should definitely switch your brokerage account. Next, there are no trade minimums and no account minimums, meaning if you want to buy and sell, it doesn't matter how much. This is true 100% for Schwab or Fidelity. If you want to buy into one of their mutual funds for even $1, you can do that. With Vanguard, they do have select funds where there's a 3,000 minimum buy-in, but they still allow you to buy ETFs one share at a time. But of course, to open an account for all three, you don't have to have a minimum initial deposit. And for all three of these banks, they have zero annual account maintenance fees. If your brokerage account is charging you a percentage of your portfolio or a dollar amount per year, just change banks. The only asterisk I have to give is that Vanguard does have a $20 annual maintenance fee if you do not sign up for electronic delivery of their documents, but you can easily avoid that, and all three of these banks are cost you nothing to have year to year. The customer service for all three of these banks is excellent. There's a telephone number that you can call and you can talk to a real person if you have a question or need help with your account. Schwab is the only one that actually has 24/7 phone operator access. The other two you have to call between the hours of like 8 in the morning and 8 o'clock at night. And then most important, when you buy into one of their ETFs or mutual funds, they have the lowest expense ratios in the industry. So Fidelity right now is offering zero expense ratio funds, but for Schwab, you can get ETFs at as cheap as 0.02%. With Vanguard, you can get ETFs for as cheap as 0.03%. These expense ratios are virtually nothing. You will not feel the difference, in my opinion. So when you partner with one of these banks and you buy their products, I'm guaranteeing you that you're getting the lowest costs in the industry. So that's the complete checklist of what these banks are doing well. Let's talk about now how they slightly differ. And to understand how these banks are different, you have to understand how they're structured. Charles Schwab is publicly traded, publicly owned. Fidelity is privately owned. And Vanguard is actually investor owned. And this is how they're structured pretty much shapes all the decisions that these companies make. So for Charles Schwab, their founder, Charles Schwab, at some point offered an IPO in order to make the company publicly traded, so you can buy shares of Charles Schwab on the New York Stock Exchange. It's important to remember that this company, the primary objective is to earn a profit for their shareholders. In order to have voting rights to select the board of directors for this company, you have to be one of the largest share owners of Charles Schwab stock. So there's nothing wrong with that, but it is important to remember the primary motive of this company is to increase the share price for their shareholders. And Fidelity is privately owned, and it's owned by the Johnson family. The CEO is Abigail Johnson, and she's a billionaire. Some people like that it is a female CEO, and the Johnson family, collectively, their net worth is between like $20 and $30 billion. Fidelity is an excellent company, but you got to remember this is a privately held company, and the objective of this company is to earn a profit for their owners. And then finally we have Vanguard, and their former CEO, Jack Bogle, pretty much invented the low-cost simple index fund back in the 1970s. And he structured the company so that it was actually investor-owned. So the objective of this company is not to maximize profits for shareholders or the owners. It is to reduce costs and pass those on as much as possible to the real owners, the investors who own the Vanguard products and services. And for that reason, Vanguard has been the go-to king of low-cost, simple, no BS investing for decades. And I feel like their market share was gaining so much. They're the largest mutual fund bank and second largest ETF bank after BlackRock. And I feel like Schwab and Fidelity saw the tide turning and they had to change their business model. So Schwab and Fidelity are offering lower expense ratios, lower fees to draw in new customers to compete with Vanguard. Because once somebody opens a retirement account or a brokerage account, usually they're going to just keep investing with that company the rest of their life. So Schwab and Fidelity are really in a position where they need to be more competitive in order to take market share away from Vanguard. So now that you understand how these three banks are structured differently, you'll kind of understand why they're different in some ways. The first difference is Charles Schwab and Fidelity offer trading platform software in real time. So of course you can buy and sell on their mobile device, you can buy and sell on their web platform, but with Schwab you can download trading software. It's called Street Smart Edge, and if you want to be more active, maybe a day trader, if you want to get in and out of positions without any delay or lag, you can use Street Smart Edge. With Fidelity they offer Active Trader Pro. Neither one of these platforms are as well known as TD Ameritrade's Thinkorswim, but they're still pretty good. Whereas Vanguard does not have any trading software available to their customers, and they haven't made any announcements or plans to offer any. Schwab and Fidelity also started offering fractional shares. Younger, small dollar investors really like fractional shares. And with Fidelity, you can buy any stock or ETF. With Charles Schwab, you can just purchase fractional shares of S&P 500 companies, but they're probably going to expand that to small caps and ETFs soon. Vanguard, they don't offer fractional shares. They've made no announcement in the future of offering fractional shares. If you're watching this in the future, potentially they've rolled out this service. Fidelity and Schwab also have physical in-branch locations that you can walk into and talk to a person face-to-face. I don't know how many locations Fidelity have. It looks like a lot, but Schwab has, I think, close to 400. So this is just A through C, and these are all of the branch locations if you want to go talk to somebody in person when investing with Schwab. Vanguard has 4 locations, just North Carolina, Arizona, Pennsylvania, and DC. Once again, the objective of Vanguard is to keep their operating costs as low as possible to pass that savings on to their customers. So at this point, you might be seeing the pattern here of the difference between Fidelity and Schwab and Vanguard, but there's more. Schwab and Fidelity offer credit cards. So the Fidelity Visa Rewards is actually a fantastic credit card. It's a 2% cash back on all purchases. It then auto-invests that into a brokerage account or any Fidelity account for that matter if you want. Schwab similarly has a no annual fee investor credit card, but they also have the co-branded American Express Platinum card, which I think is pretty good if you're interested in a high annual fee credit card. Schwab and Fidelity also have checking accounts. You can get a cash management account with a debit card, and then you can pull money out of your account whenever you want. And at this time, Vanguard does not offer those additional services such as checking accounts, debit cards, or credit cards. So at this point, you might be wondering, how do these banks make money if they have no annual fees and very low expense ratios? One of the biggest ways is they offer margin trading. If you're not familiar with margin trading, you basically can borrow against the equity of the stocks you own with that brokerage to take out more money. Here are the interest rates for Vanguard, if this is something that interests you. Here's the interest rates for Fidelity. You can pause the video if you want. Here are the interest rates for Charles Schwab. So on the low end, if you're a low dollar investor and you want to borrow money from your broker to buy and sell securities, on the low end, on the high end cost, low end holdings with the brokerage, you can expect to pay 8.3%, 8.5%. If you have a net worth in your account of over $1 million, so here's Vanguard, $1 million, they're offering an effective interest rate of 4.75%. Fidelity, it's actually the cheapest, if you're a millionaire, so only 4%. So the more money you hold with the brokerage, the cheaper it is to borrow money from them. And of course, they love it when you borrow money from them. This is basically a no-risk investment for the bank, so they're earning that APR on whatever you borrow from them. The next big way that these banks make money off their customers is that they will invest your uninvested cash in your brokerage account. What does this mean? If you were to deposit $5,000 into your Schwab account and you then didn't buy something with it, Schwab is going to take that money and invest it for you, and they're going to keep that money. So with Schwab and Fidelity, they're only going to give you a small fraction of what they earn from your uninvested cash. It's something like 0.01%, or maybe even for Fidelity, 0.08%. Vanguard is the only one that will invest your uninvested cash and then pay you what it's worth. Because interest rates with the Fed are so low right now, Vanguard is only paying something like 0.7%. But once again, this goes back to the mentality of the company. The objective of Vanguard is to increase profits or increase or decrease the cost to their customers, who are the owners. So if you have uninvested cash in your brokerage accounts, Vanguard will help you make money on that. Schwab and Fidelity are going to keep that money for themselves. Additionally, if you partner with Schwab or Fidelity, they are going to sell your information to third-party people. So if you were to plop $10 million into your brokerage account, this would set off all kinds of alarms, and you might be getting phone calls and direct mailers from separately managed asset managers. These are called SMAs, and these are people who are going to try and sell you their services, mainly actively managed mutual funds. Now, on my channel, I'm never going to recommend an actively managed fund because they have really high expense ratios. They also have a lot of hidden fees sometimes. Now, with SMAs, anybody who partners with Fidelity or Schwab, these are good people who have they're trying to help you earn greater than just a simple low-cost index fund. But once again, on my channel, I'm never going to recommend you go with these people. But just know that when you're with a for-profit company, they have to find other ways to make money. And partnering with these SMAs, if these SMAs can sell you on their services, then Schwab and Fidelity will get a kickback for partnering with them and allowing them on their platform. But you're watching this video, so you know the tips and tricks. Basically, if you go with a for-profit investment bank like Schwab or Fidelity, don't leave a lot of uninvested cash in there. You know, transfer that to a high-interest savings account if you want to hold cash. And don't ever participate in actively traded funds. I personally just don't think that their returns justify their costs. The final point we have to cover is the user experience when visiting their website or using their mobile app. This is part of the reason why Robinhood is so popular. Their app is easy to use, fun to use. With Schwab, Fidelity, and Vanguard, I've made complete platform tutorials and mobile tutorials for all three of these companies. You can check out these videos if you want to see exactly what they're like. But I have to be critical of Vanguard here. Their website looks like it was designed in 2006, and it has not been updated since then. I really just don't enjoy using Vanguard's web platform or mobile app. And this is a huge problem for me because I'm trying to be more active with my investments. And to go onto this website, it's just kind of clunky and not intuitive, and it's not a good user experience in my opinion. Fidelity is a little bit better if you don't mind seeing all that green everywhere, but hands down the best user experience in my opinion is Charles Schwab. Just the black text on a white background with a little bit of blue here and there. I feel like Schwab's platform and mobile device gives the best user experience. So when comparing all three of these, I just give them a slight edge over Fidelity, and obviously Fidelity and Schwab are way better than Vanguard. So which is the best brokerage account or retirement account for you? Well, if you're a buy and hold investors and you don't want any of the gimmicks or extra thrills or BS, go with Vanguard. Vanguard has your best interests at heart, and this is a company that's basically never going to change. This company is going to keep doing what it's been doing basically for 40 years. If you're a buy and hold investor and you want the extras, you want branch locations, you want a checking account, debit card, active Trader Pro software, then go with Fidelity. If you're not using their website every day, I think Fidelity is an amazing option. However, if you want to be more active, if you want to be more than just a buy and hold investor, and you want the extras, then I think Charles Schwab might be the best option for you. And of course, a quick disclaimer that all three of these banks are fantastic. You can't go wrong with any one of them. However, these banks do change their policies and services over time. So if you're watching this in the future, just do a little bit more research to make sure that the bank you go with is the best for you. Okay guys, if you enjoyed this video, give me a thumbs up so the algorithm knows it's good. In addition, consider subscribing if you haven't already. I talk a lot about finance and investing videos. I've also made a playlist of tutorial videos for all three of these companies, so definitely check those out if you're interested in specifically one of them. And if you have any comments or questions, leave me one down below. I'll try to help you if I can. And until the next video, take care.